Hello friends, last week in my video we discussed a sector that was dragging the markets lower, and I told you it was banking and financial sector stocks which command a 34.6% weightage in the Nifty 50 and was a swing sector. Well, that sector worry remains open, but there is a bigger trigger now that has come forward and presented itself. In this video, I want to discuss how it can impact your trading in the coming weeks ahead. Do remember that the coming time is a very critical time. You have expiry of the January series coming up. You have the budget coming up. Then you have the Monetary Policy Committee meeting approximately a week after the budget. And therefore, it's quite a news data driven week. And of course, the week after that too. So there is going to be guidance about interest rates, cost of money, etc. And this is what is going to have a bearing on how you should be trading. I hope you've enjoyed the videos that I have made this week and they've added tremendous value to what you are learning from me in these videos. Now let's jump right ahead to the normal format of our videos, and coming up on your screen is the weekly market roundup window. And as you can see here, what is immediately apparent is the fact that the decline was led by the broader based Nifty 50 yet again, with the Bank Nifty bringing up the rear. The US dollar index cooled off a little bit, and that basically gave us some respite, which is why the selling pressure has eased a bit. Now, a falling dollar index boosted hard assets, particularly bullion, and crude oil and natural gas went up due to number one, the seasonal factor, number two, geopolitical aspects as well. Do remember, winter is a time when natural gas is the heating fuel of choice for indoor heating. And once the winter subsides, natural gas prices also come down. Now, the Indian rupee continued to decline against the dollar, hitting 86.66 on a weekly closing basis. I'm talking on the prompt month futures, of course. Indian 10-year benchmark bond yields went up just a tad, which means bond prices fell a bit. Now, more on the bond issue later. Do not skip the bond segment. NSE market capitalization fell just so marginally, which means the broader based outlook on the markets was that of slight nervousness. Market-wide position limits went up routinely, and the US headline indices went up across the board, which provided tailwinds to our markets. Friends, I now come to the ratio chart. This is the Bank Nifty divided by the Nifty 50. Why do I do that? Because of the sheer weightage, as you can see in the chart on the corner of your screen. Weightage enjoyed by the banking and financial sector stocks, and whichever way this sector goes, that way the market goes. Now, coming back to the ratio chart, notice how the ratio attempted to firm up a bit, but it's still way below where it should be. For a sustainable up move, I want this ratio to be higher than 2.35, if not 2.45. That's a long way off. So unless that's happening, I don't think you're going to see any sustainable up move coming in a tearing hurry. Now, friends, I come to our in-house indicators. I start with the market-wide position limits. It's by and far one of the most reliable do-it-yourself indicators that I make. We are seeing levels of 36.28 in a week before expiry. Now, that is way higher than what we saw last month, lower than what we saw in the 3 months prior to the last month, which means although sentiments seem to have improved a bit, they are still below the historical average. Now, there's unlikely to be a significant rally in the MWPL in the week because of the expiry factor. And what we do need to know is how the MWPL falls, or rather how much it falls on expiry day. Now, on the expiry of December, we saw a post-expiry fall of 24.45. We need to see in the coming Friday whether it falls above or below 24.45. We'll come to it, of course. Now for stock and index futures turnover, what we are seeing is the index futures turnover fall marginally, whereas stock futures turnover rose a little bit. Part of it could be attributed to the impending expiry of the January series and traders shifting on to February. And part of the reason, of course, is that they participated in the volatility. And any which way, higher volumes are good because they reduce the bid and offer spreads. Friends, I now come to the advanced decline ratio. What we are seeing is that the Nifty losses narrowed down and the advanced decline ratio improved substantially by rising more than 100%. So in the prior week, it was 0.76 and last week it was 1.60, which means for every 100 falling stocks, there were 160 gaining stocks. Now, as long as the advanced decline ratio remains above 1 with rising prices, bulls are in control. So do watch this number, please. And I share all this data on my social media accounts every evening. So do connect with me. My contact coordinates come at the fag end of this video and in the description and pinned comment below this video. Friends, let's take a look at the basis. Now, basis is nothing but the premium or discount prevalent in the future compared to spot. Higher the basis, higher the risk appetite, lower the basis, lower the risk appetite. But do remember, basis, futures basis is exactly like options premium. As we head towards expiry, the basis erodes. That's time decay. And sure enough, the basis of both these headline indices, the Bank Nifty and the Nifty 50 ease because we are heading towards expiry, but the basis remains positive. It's only when the basis inverts or trades at a discount to the spot that you should witness some short selling. So as of now, it doesn't seem to be indicating too much of a panic. Now friends, for our in-house indicator, the impetus, you've trusted it for 4 years now and it stood the test of time. What we are seeing is that the Bank Nifty impetus fell, even as the Bank Nifty index itself fell. That means the selling was very mild. On the other hand, the Nifty impetus has risen and the Nifty itself has fallen, which means there was forceful selling on the Nifty itself. So the broader market is still seeing an overhang of selling last week. Now for our exclusive in-house indicator, the lift, weight, thrust, drag indicator, I share this and the impetus on our social media account every evening. What you are seeing is extreme volatility from an extremely low level of 0.92 in the minus in the week prior. The impetus has jumped to positive of 0.56, which is almost the 20-week high. Now that tells me that there is a possibility of short covering or maybe even fresh buying on declines. Do remember, it's the expiry week. Typically, on expiry, people tend to roll over their longs more than they roll over their shorts. So shorts get cut, which is what the LWTD seems to be indicating. Now friends, I come to the crux of this video and to the bond market. Now, I've been tracking bond markets before equities, before any other asset class since many years because I've been sharing my view with you that it is the asset class that funds the price discovery of the other asset classes. This is the fountain of money supply. Now, look at the weekly chart of the Indian 10-year benchmark bond yield. The candlesticks are the 10-year benchmark bonds. The blue line above the candlesticks is the Indian 30-year bond yield and the maroon line below the candlesticks is the Indian 2-year bond yield. What do you see? What you are typically seeing is that the bond yield of 30-year tenure bond is significantly higher at 7.078% compared to a steep discount at 6.648% of the 2-year bond yield. Now, why is the steep discount of almost 50 basis points? It's not exactly 50, but almost 50 basis points. Why do bond yields rise? Now, do remember that a 100 rupee bond, the face value of 100 rupee bond, giving you an interest rate of 10% means it will give you an interest of 10 rupees every year. If you are to buy it at 90 rupees odd, which is a 10% discount, your yield will not be 10%. Your yield will be 11% plus. So what happens is that the yield depends on the bond price. The fact that the bond yield has gone up, the 30-year bond yield is up and the 22-year bond yield is down, tells you that there is some amount of selling in the 30-year bond yield, which is why the bond yield is rising. Why are bond traders offloading the 30-year bond? Very simple. This is something that I have been contrarianly telling you, that I expect cost of funds to go up. And this is what exactly the bond market is trying to tell you. They are expecting bonds to come up, new series of bonds to come up and offer a higher coupon rate. Do remember, I've shared many articles with you on my Telegram channel, and I've shared the hyperlinks to mainstream media articles where HDFC Bank, SBI, Bank of Baroda, Canara Bank, etc. are all announcing, and of course the private sector borrowers, NBFCs, are announcing that they are willing to pay higher interest rates, which means cost of funds is definitely looking like it's going up. I have been stubbornly telling you that I do not subscribe to the view that rate cuts are going to come, or even if rate cuts are going to come, they will be aggressive. And even if headline rate cuts are announced, I've been very openly telling you cost of money is going to go up, because at those particular rates, headline rates, you're not going to be able to borrow money from institutions. What does it mean? What it simply means is that risk appetite in riskier assets over a period of time is coming down, because interest rates and cost of money are going to go up. The markets are now slowly but surely headed towards a risk off sentiment. So far we've been risk on. Now it is risk off, which is what I have been telling you since end of 2023 will be the beginning of pro-cyclicality in financial assets from 2025. Cost of money is rising. You cannot expect a runaway rally in riskier assets in 2025 when interest rates are going to be remaining elevated, period. Which means interest rate sensitive stocks, which I have been warning you against since months, even when everybody else was exuberant, are likely to remain under pressure. Let's be careful out there. And do remember, they command a weightage of 34.6% in the broad-based indices. You have 34.6% of the market being nervous. Now friends, the bond market done, I come to the Bank Nifty, and as the daily chart on your screen tells you, it rose on 3 out of 5 trading sessions, but in the bargain surrendered 0.4%, all thanks to Friday, which was a slam dunk day. Now why is Friday very important? Because of what you're seeing on your screen. This video is something that you must see. All the videos that I want you to see, the hyperlinks to the video are in the description and in the pinned comment below this video. Now, why is Friday's price very important? It's covered in that video. Let's save time. You can see that video on at leisure. And what it did was set the tone and tenor for Monday's open. Now, the price itself has closed below the neckline of a very unconventional head and shoulder pattern, and the monthly moving average, which itself is looking like it's under pressure. Now, that makes the short-term outlook appear nervous. Let's now switch to the weekly chart, and the price has violated, as you can see, a long-term 5-year bullish trend line. Now, that's very, very significant. As basic Dow theory analysis will tell you, the longer is the tenure of any price pattern, trend line, head and shoulders, triangle, etc., the longer the tenure, the more valid and more significant is its ultimate violation. Now, the violation of a 5-year trend line is not something that you can wish away or ignore. So be very careful out here. Now, not only has the trend line been violated, but the price has closed below it for 2 weeks in a row. The price is also below its 25-week moving average, which is a proxy for 6-month-long holding on cost of an average bull. And what's even more important is that the 6-month moving average itself has started falling, which means the medium-term outlook is nervous for now as well. Can things change? Yes, they can, provided bulls managed to keep the Bank Nifty trading above 50,000 levels on a sustained closing basis for each and every day of the coming week. Now, in the week before last, this index was number 2 on the most volatile counters list as per statistical beta rankings I maintain in-house. It fell by 6 notches to number 8. Before you bring out the champagne and say, hey, let's celebrate, volatility rankings are down, do remember it's because volatility of individual stocks rose faster than the Bank Nifty, which is why, relatively speaking, it appears to be falling. Last week, I advocated an estimated range between 50,450 on the upside and 47,025 on the downside. It held perfectly well. In the coming week, I estimate a range between 50,275 on the upside and 46,800 on the downside. Now, in addition to these ranges, please also note the daily, weekly, and monthly pivots that I share on our Telegram and other channels. In addition to these pivots, please also take a good look at this tutorial video on how to use our pivot levels so that you can laser precise your entry and exit in your trades. Friends, the Bank Nifty done. I now come to the Nifty 50, which fell more than the Bank Nifty. It surrendered 0.97% last week, rose on only 2 out of 5 trading sessions, and Friday's loss again was noteworthy, even though the candle size is small on the daily chart on your screen, but the net change was noteworthy. The price here is also below its unconventional head and shoulder neckline and the monthly average, which itself is falling, and that makes the short-term outlook nervous. Now, with monthly expiry, budget, and the Monetary Policy Committee meeting approaching fast, markets are likely to remain nervous, and that means higher beta or intraday volatility. Taking a look at the weekly chart, this shows the price violating a triple bottom support trend line. The horizontal trend line is a triple bottom support, and the downward sloping trend line above it makes it a bearish triangle. Now, the bearish triangle being in play, as long as the price stays below the lower trend line of a triangle, the outlook appears weak. The price is also below its 25-week exponential moving average, which itself is falling downwards, and this average is a proxy for a 6-month long holding on cost of an average bull. So, the medium-term outlook is nervous as of now. All that can change provided the bulls manage to keep the Nifty 50 trading consistently above the 23,425 levels in the coming week, and that to every closing day. Now, in the week before last, this index was number 18 on the most volatile counters list, and it remained there unchanged. Here again, individual stock volatility rose faster, which is why the Nifty 50's volatility appears to be lagging. Last week, I advocated an estimated range between 24,150 on the upside and 22,725 on the downside, which held perfectly well. In the coming week, I estimate a range between 23,875 on the upside and 22,525 on the downside. And in addition to this range, please also watch our daily, weekly, and monthly pivots, and also this tutorial video on how to make use of our pivot levels the best for laser precise trading. Friends, I now come to the last bit of statistical analysis wherein I share the retail risk appetite based on the turnover contribution by the 4 segments in the market. On your screen is a weekly chart of this turnover contribution. Index futures turnover contribution was stagnant. Stock futures turnover contribution went up by 11 basis points. Index options turnover contribution fell by a whopping 93 basis points. Stock options turnover contribution went up by 84 basis points. Basically, stocks are more volatile than indices and futures are more volatile than options. In the options and the futures segment, turnover has gone up in the stock space. Why? Coming expiry. Rollover has already started in earnest. Now, friends, I come to my strategy. I'll keep it brief. It's going to be largely unchanged because what we have, like I said, news triggers in the week ahead. Now, PSU stocks, or public sector undertaking stocks, remain the mainstay of my trading strategy. Why? I've explained to you in this video as to why I prefer trading PSU stocks. That does not mean I only buy. I'm talking about trading, buy and sell, long and short, because of the higher ranges that they are offering and high volatility. Interest rate sensitives or IRS stocks remain on my heads up display, and because of what I explained to you in the bond segment itself. In the hard asset space, which means commodity space, bullion is likely to see buying on declines because of defensive buying purposes, whereas industrial metals may witness some amount of resistance on the upside, even as the usual month end short covering might just be seen, which means metal mining company stocks are likely to remain volatile. There might be a buying support emanating on them on declines. Now, oil and gas stocks will also remain volatile because the underlying commodities themselves are volatile. Now, at least till the winter subsides, oil and gas will remain high on beta, which is volatility, and provide traders with a lot of intraday trading opportunities. But these are markets which are known to be called as widowmakers, and unless you're really used to the idea of trading them, you should basically walking cautiously in this market. Now, my strategy for theta decay remains evergreen in interest rate sensitives and oil and gas, of course. Friends, if there are any more ideas I need to convey to you, I'll be more than happy to share them on my Telegram channel and other WhatsApp groups. So do please stay connected with me. Before I wind up this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here, and a request from me. My videos are made with a lot of love and affection, time, effort, and a humongous amount of concentration. They remain free and will always be. It would give me a tremendous amount of satisfaction if you can share my videos with your friends, family, and social media groups. I thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Take care. Bye-bye.